Hello everyone, today is October 1st and this is session number 4 of the Wyckoff Trading Practicum course. The remaining sessions on not on the 6th, on the 8th, on the 8th, 15th, 22nd and 29th. In the announcements, October special, looking forward to that. It kind of will make a lot of sense, when it all comes together in December. December special is going to be kind of like the evolution of the material that I've been going through in the last about 10 years or so. So I'm going to present to you guys the finalized system based on Wyckoff methodology and price cycle and all of that stuff, and it's going to encompass a lot of the different layers. So December special is going to be we're going to build up to that, and you kind of could sense maybe that I'm already working on a lot of material that goes to that particular to those particular sessions. November special is also going to be interesting with the discussion about momentum and volume. John and I in October special will be discussing momentum, and hopefully we'll have some volume characteristics there as well. And October special, I think also it's going to be probably 2 steps, October and then February or March. And February or March is going to be more advanced, but you will have to go through the first one in order to go to the second one. So I'm looking forward to all of those. Today, what are we discussing? Oh, okay, I didn't correct this, so we're not going to stay on significant bar today. We're going to discuss kind of like 2 things that are somewhat related as a topic. So we were discussing significant bar analysis and the stop losses associated, how we're moving the stop loss based on the significant bar. Today we're going to talk about volatility and what that plays as a role in how we manage our position. And then from that discussion, we'll jump into the discussions of the trend, because volatility occurs in specific places in the trend, in the price cycle. So we want to recognize where they occur. And then we'll have kind of like this exercise on trend identification. And we'll see where potentially it's going to take us. As usual, buyer's game, we'll discuss that. Oh boy, that was a very interesting one. We'll talk about our anatomy of the trade, which is also extremely interesting. I'm actually really grateful that we picked up that particular stock at that particular structural point, because it's all about how do you manage the trade right now. And then, as always, there are some Q&As, so we'll go through those. Stop the recording, watch the whole disclaimer. Everything that we've talked about and discussed in these classes is only for educational purposes. Okay, well, let's go to our bias game. I thought it was very interesting. I actually would like maybe to have a discussion at this point, because I think this is something that we need to stop and discuss a lot. This is very tricky. So going through your homeworks, which, by the way, thank you guys for sending those. I always go through your bias slides, and I try to understand the logic which you apply to charts. And I try to think about why you were thinking that this was, let's say, accumulation over distribution. What are those common logical steps that you guys see on the charts? And I think that predominantly, and please, agree with me or disagree with me on this, predominantly, this is the thought that a lot of you have had. Looking, and let me just take another color. Looking at this movement of volume in general and then supply in particular. So this is the observation that we are making, and that leads us to an erroneous answer. Because we're thinking here, well, volume is going down, so supply is diminishing. And that's true. But we never fully engage with the opposite side of the effort, which is demand. And you might argue here, okay, well, what is happening to the demand here? Wouldn't we see that as well? Wouldn't we kind of like see that demand is also diminishing? Okay, well, great. So we have a picture where both supply and demand are diminishing, and that diminishes, the overall volume signature. So then how would we resolve this dilemma? How would we be dealing with this, guys? I mean, like, what else would we be looking at in this situation where maybe volume is not that telling? And I mean overall volume. Do you guys have any thoughts, comments? And let me just unmute you guys, just say unmute, and let's just kind of discuss this, because I want to hear your thoughts. As I said, this was probably the most interesting bias game so far in the since the beginning of this semester. Thoughts, comments, remarks, questions? Okay, well, I see that Eric is going in the right direction, so let me just see any other answers before I'll release his answer. Anything else? What do you guys think? How would we look at this picture when we see this diminishing volume signature on both supply and demand? What else would we be looking for in identification of the bias? Okay, Simon is saying structure. Definitely, I mean, like, we definitely will be looking at the structure, but what specifically within the structure? Rick is saying price spread could be somewhat confusing, especially when you think about the supply going down and demand going down, Rick, right? So what would that remind you of? Probably this indecision point where there is a contracting characteristics to the structure. And we kind of see that also from this structure a little bit of the triangular. Okay. All right. Anyone else? What else? Okay. Rami is saying momentum. Interesting thought, Rami, but in what regard would you be thinking about the momentum here? So if the effort diminishes, we would be thinking that momentum would be diminishing as well. And if we would look, let's say, at this rally right here and compare it to the previous rallies in the uptrend, we would most definitely say that momentum has diminished, right? Okay, so if you're thinking about the momentum as a function of how the price moves, then I think you're on the right track there. Simon is saying, looking at the rallies and reactions and comparing those with others, analogs, in conjunction with the volume signature. Look for texture and where CO is active. All right. Well, let me come back to Eric. Eric had this comment. What about results versus efforts, or ease of movement up versus down? And I think that's what it comes down to. I think this is the dilemma that we are facing, as kind of like you go through the initial beginners, intermediate level type of layers of analysis, and then you come to something like this. How do you make a judgment here? And I think that's the next layer where we're just basically saying a common sense definitions, the ones where we say that the volume confirms the price, they don't work in this environment. So what would work in this environment? Well, the way how the price moves and the intentionality behind it is extremely important, right? So for instance, looking on the upside, we had a really good uptrend, then we had a really good rally, and then look at the next significant rally that we have. So we're seeing the deterioration of the demand qualities. With that, obviously, the momentum is also deteriorating. We also see that in the volume signature, right? So here's the demand signature on this latest rally. Here's the demand signature when demand is healthy. It's either increasing or it's consistent. So it's either has urgency and therefore you have a lot of gaps, momentum up, or you have the consistency of the push that suggests that still, there is some buying behind it. On the reactions that are intermediate kind of like reactions, you have the momentum push that suggests the sustainability of the overall trend. And that is being confirmed also by the consistent demand signature. What do we have on this rally? On this latest rally from January to July, to June. Laborious move to the upside with a lot of reactions, right? So we have not had this type of behavior where there's going to be a reaction after reaction after reaction. Let me just erase all of this. So I'm looking at this, this, and this. One might argue, well, what about this reactions here? I think this is a part of this formation, of this reaccumulation with its phase C somewhere here. And this is just an upthrust action in B. So it's more of the horizontal structure by itself. Here we clearly see that there is a trending up channel. But the way how the price travels up, it really is concerning. So therefore, our attention goes to the demand, and we see that demand is of no good quality. Intentionality. We wanted to overcome this resistance, and we'll talk about this resistance in a second, and do what? We wanted to stay above it if this is a sign of strength, right? So it's always a situation of the upthrust or a sign of strength. Okay, so, and then we're failing from here. Well, what about a situation, or you might say, where this could be phase B, and then this upthrust still in phase B, and then we're going into phase C. Wouldn't then the volume signature work like this? Well, definitely we could say that, but think about the change of behavior. And the change of behavior, as I've stated before, is different from a change of character. So a change of behavior could be one attribute of, let's say, bullish behavior that we should see here. It could be maybe like a bullish rally in the middle of the trading range that shows that the demand is in control. Or it could be a bullish reaction. And it could tell us that, okay, so demand is in control. Or bearish, bullish reaction that would tell us that supply is exhausted, or supply is poor, or exhausted. Supply could be exhausted for different reasons. There is an exhaustion from selling, and then there is an exhaustion from selling where they just sell and then they go away and nothing happens. And I think from that perspective also, from that reasoning, we could also have another layer of confirmation. So let's kind of follow that logic. Supply is exhausted. Why? Well, because they sold into all of this rallies. So they sold here, and obviously this is a value selling into the strength of the whole rally. Then the second time they sold was something similar. And when I was looking at this slide and I was thinking about the description of the Wyckoff story, I wasn't really seeing a lot of supply here that would, let's say, derail us from this trend right here. That was still in line with the trend. The only bearish characteristic here was a diminishing upthrust or upward thrust. So momentum was deteriorating, and there was no really good volume signature at the end of this move. So naturally, where would the price come, on the reaction? into the end of the channel, and also into the momentum move that we have had right here. So from the volume signature and the way how the price moves, you should detect an increase of the momentum. Whenever we have a loss of momentum, but the price continues, usually reaction will react to that price level where momentum still has a lot of strength. Why? Well, because the value zone is established. Here it is. And then this is where they would be buying. So nothing extremely dangerous yet. Yet there are some signs that, obviously some selling is happening. And I think this was very telling. So this is where the story changes. And here we're seeing that the reaction and the way how it results itself into a downswing that is increasing in distance. In distance traveled. So we have one reaction, we have second reaction, now we have third reaction. And it's interesting that as a result to the downside increases, what kind of effort it is required to have that type of extension. And we're seeing that overall, we probably would be looking at the decrease of the effort to the downside. So it takes smaller effort to push the price more to the downside. So from here, we're concluding that this type of action would be called how, by the way, guys? Really quick pop quiz. So the price moves to the downside more on the diminishing effort. Okay, Simon is saying ease of movement. Absolutely, yes. Eric is on that as well. And so is Rick. Excellent. Okay, ease of movement. So we're moving to the downside with more ease, and yet, even with that, there is some selling. And it's accelerating because we're seeing that in some instances we could have this selling, let's say, that starts to occur in the reaction at the beginning of the reaction, and then it kind of like slows down into the end of the reaction. So that tells us that there is an exhaustion of sellers. Whatever they are selling, they have sold. There are no more sellers or just fewer, and that usually provides with an assumption that there's going to be a resumption of the rally. In a way, this happens here as well. So a lot of supply here, and then on the next leg to the downside, we're seeing how the price goes to the lower low, how it did in the first reaction. But supply level is really low. So we're thinking there's going to be a rally from here as well. The third reaction has a different construct. Look at how supply is increasing with each leg to the downside, which we have 3. And we'll talk about this today as well. So this is all in line with today's material. So this is different. This is where supply increases more, supply increases even more. Obviously, demand is coming in here at this point of value. So we're seeing that not only in the ease of movement, we're seeing that switch from the bias to the upside to more of the bearish bias, and now to be proven, to be confirmed or to fail, bearish bias that is. But we also see that in the construction of how supply comes into the market. All right, well, we've talked about the rally. So demand is diminishing, intention is not fulfilled. So with that, we're still with the bias to the downside. And then what happens next? And we'll talk about, some of the complaints here at this point, why the chart stops there. So what happens next? Demand cannot push the price significantly higher for the price to stay above the resistance and to occupy the space above that resistance. It fails instantly. in the upthrust manner. And as we are thinking that selling has occurred here, and then here, there is some here, then because of the poor demand, we don't have to have a lot of supply to push the price down. So it's almost like that we're looking at ease of movement again. But now that ease of movement is going to happen in the environment where both supply and demand are kind of exhausted, and they are less and less and less in the signature. So whatever prevails is going to be the bias. And I think that's that next layer for us, and understanding how we actually deal with the bias determination in the environment where the volume signature goes down. It's in the result. It's in the ease of movement. All right, so let's see what kind of comments we have here and if that all makes sense. All right, from B3, okay, let me just see this. Okay, this distribution is a great parallel to a trade that was available to us in the hourly chart E-mini S&P futures. I agree. When you look at the analogs with the markets, this change of behavior has happened at the top of the 2018, January 2018 rally, the conclusion, and then February 2018 low. Then we had reaccumulation here, absorption, and then there was a very weak rally into the upthrust situation. So this is a really good observation, yes. Longer swings to the downside, ease of movement, and rallies back up really struggle. Okay, great. Great comment, Dmitry, and great pickup right there. Eric is saying volume picks up on the last move down. Yes, we definitely, would be seeing this. And again, you might be thinking here as we thought about this increase in the supply, right? So not like this, but more like that, right? So if we would take everything, so we're probably doing it like that. So there is still increase of the supply as the price goes down. Why is this important, guys? This is something that I'm going to be talking to WTC students as this is going to be extra material added in this cycle on the swing analysis. It's important for us to identify how the swing unfolds in order for us to understand how the buying or selling happens. Is it only happens at the beginning of the move and then momentum goes away and that buying and selling goes away? Or is there acceleration of the bias? So Eric here is picking up, on this. Eric is hot today, so many great answers. So the increase of the supply pressure comes at the end of the move like it happened in January. So therefore, it suggests that as the price goes down, there are more people, market participants who are selling. They are more willing to depart from their position as the price more goes down. And that's disturbing because if the price would go down, we would probably see acceleration of this price to the downside of that trade, trend to the downside. Now, one more comment, and then we'll go, to the solution. Couple of the students I had these comments were saying to me that their preference would be to see some kind of reversal bar at the end, like the last bar should be a reversal bar. That would identify the next swing to the upside. Okay, well, I wasn't really thinking about this. It might have come more unconsciously with this example. So here's your reversal bar. Here is your commitment to the downside, and then this latest bar reverses not just that bar, but the 3 bars before that as well. What does it mean? Does it mean that we're going to have a rally here to the upside? Yeah, we could. We had the reversal. We could probably go one more bar and then reverse back. That could be also a situation that could unfold. So the key was the bias game, and that was from the beginning, and that's how I'm asking my content team, to create the initial slides where we have to uh, we have to figure out the bias from the data that is given to us. And this means that you have to go through the whole story from the beginning to the end, and you have to logically, create it and construct it. All right, so let's see the solution. Here we are. By the way, I'm kind of included, and I think that this is going to be valuable for us as well. And we have, good data points now, 214 votes last time. That we had on this particular bias game on Twitter. 57% have said and stated that this is an accumulation. And I think that this was a very difficult bias game, so I can't really, I can't really say that it wasn't. I've given you the chart at this point right here, and you could see the whole downtrend unfolding. That was, of course, very market structure related, but and this stock, particularly with this stock, the difficulty about this stock, if you think about the market history and what has happened in 2008, the market was already making lower lows, right? So the structure was something like this. So at this point of time, this stock is stronger than the market. So naturally, for institutional money managers, what are they going to do in this environment when the market is going down? They have to be invested in their positions. So they will naturally be inclined to go into the positions that are outperforming based on relative strength. And these are kind of very interesting questions with the money managers. And it happens not that often in the markets, because you have to have that cyclical big downtrend to be in this type of the situation where the leadership is holding up, and then it just collapses. The most recent example of this was in 2018, where we had that reaction to the downside, and a lot of the leadership like Nvidia or Apple looked exactly like this. There was a tendency to stay in the leadership, and that's what created that type of structure. Why is this important? Well, if we would be thinking about when it happens in this cycle, in the price cycle, we would know that the market was already in the downtrend. And then we know that this stock was still occupied and populated by many institutional investors. Why? There is a relative value for them in this stock at this point of time. So I'm not saying absolute value, relative, because absolute performance here is just basically break even. But relative to the market, you are outperforming. So naturally, they would be thinking, if we are outperforming, our clients are going to be satisfied, even if the stock, just goes down and the market goes down even more. And that outperformance usually, especially during the bear markets, produces influx of new money and increases the assets under management. So naturally, they will be still populating this position, and with that, they will overcrowd this position. We kind of could see how the institutional volume signature is not picking up, right? So they're just staying. Some of them, like value investors, got out, and that's what stopped this movement from further moving up. This poor rally is just a function of a lot of institutions are crowding this particular stock and not getting out. Why is this important? Because when they will, it will collapse fast, as majority of them will be trying to get out. And we see that both in the volume signature that increases dramatically. So this is where institutions are capitulating. And they're capitulating out of a liter. And this capitulation, it just happens in the same way, you know, and we'll discuss this. There's going to be value capitulation first. That value capitulation is going to be on the way up as the price still goes up into the strength. Then there's going to be an early capitulation right here, institutional that is, late institutional capitulation, and then general capitulation, where both retail and institutions are just getting out no matter what. And we'll study all of those. Please note that there is really not a lot of signs of distribution in this area whatsoever. There are none. There is really none, with an exception of maybe this one here, but you know, I don't even count that. You know, there was just exchange of shares here, and somebody, you know, distributed the stock and somebody picked it up. So obviously just exchange between the strong hands and the weak hands. So whenever we talk about distribution or distributional structure, the assumption is that distribution happens throughout the whole structure. That's not true. I mean, like, the chart does not show us that. And if there is one thing that doesn't lie, it's the chart, right? So we have seen this from the volume signature. There is no heavy institutional participation from the beginning of 2008 into August. The distribution has happened before based on value or over value, and then distribution happened on the way down. And we see that some of the institutions were luckier and smarter. You could see the smartness of money based on their exit. And then some of them were just trend followers and some of them were just weak hands. All right, let's come back. Something that I said that produced a lot of comments. Okay. Okay, I'm a bit confused. The last long rally from February to July is the bias up, but I think that the bias is to the downside from Simon. Simon, actually we changed the bias right here, remember, on this ease of movement, effort diminishes, result increases. So from here then, the bias is down, and because of the poor rally, then that confirms the bias to the downside. In analyzing the chart up to August, could it be assessed that supply in August is less than the supply in May? Supply in August. Okay, hold on a second. Which August are we talking about? Here, supply in August. Simon, what are we talking about? And the price may go up. Okay, supply in August, then supply in May. Okay, supply in August is more, not less. At least that's how I see it, Simon. Right, so we're comparing this to. I don't see that supply is less in August. Okay, so this right here, but this is just we're kind of like taking this out of context, Simon, I think, because we're looking, what are you looking at? You're looking at one of the reaction in the uptrend, and then you're just taking kind of like the last leg to the downside. That doesn't really make sense. If you're comparing something, you have to compare apples to apples, right? So therefore, like one reaction to another reaction, or one rally to another rally. So let's go to another question. can you explain how you drew the trading range? Sure. Okay, so that also was very interesting because the question here was where did change of character has happened? We can't really say that this is a change of character relative to the previous reaction. And sometimes it happens like this, that whenever we have a leadership, there are different ways of how leadership is being distributed. This is just one of the ways. This is where value investors are distributing into the strength, and that kind of creates a smaller distributional range right here that has its own structure, phase A, B, C, and then this causality, this small causality, produces the first initial move to the downside. And that first initial move to the downside is going to be our change of character, our true change of character. If that's a change of character, then at the low, you're going to have the automatic reaction, and then at the high, you're going to have a buy-in climax. That defines the levels of the support and the resistance. So the only thing that I've changed here for these two lines is really just the slope. Slope here, I'm just looking at as many points of touching as possible on the resistance. That's number one. And support, I'm just seeing that there was this higher-low tendency, and I'm just using that for in this particular case. You could have done it like this, which would catch this area so nicely, would not catch this though. So that's how it's done. I've done this. All right. Another question. I recall Dmitry in the previous webinar advising of a high-level view of chart. Would it be fair to say this was distribution as the price is at the top half of the trading range with increasing high volume off the top? Well, you could potentially think about it this way. Now, if it helps to identify that. So, what is it that we're doing? Okay, well, think about again two forces, and I'm still trying to come up with the more kind of evident analogy on this. So imagine two forces. One is the force of buyers, and they are leading this trend. And then another force is, let's say, value sellers. So as the price goes up and the buyers are pushing the price up, we see this from volume signature and how the price reacts. The value investor says, okay, well, at this point, this is a value point for me. And this value point suggests that I have to take profits. And maybe even exit some completely. So what is the value investor is going to do? It's going to sell into that strength. That selling increases the volume signature and temporarily stops the price from moving further up. So it's almost like a punch to the uptrend. The uptrend is still very strong, and therefore it's still sustainable, and it could absorb the supply and move the price up again. As the price goes up, the value seller again sees another value point and sells again, another punch. So think about this maybe like as a boxing, right? So first punch, the boxer gets up, still a lot of strength, could withstand a good punch. What's going to happen on the second punch? Probably less, recovery energy, just because the first punch was quite, sufficient. Look at the volume signature. This is a lot of effort. This is a big punch. Yeah, Dmitry is saying, he loves this boxing analogy. Maybe yes, maybe boxing. I would rather prefer something non-violent, but for this example, I think that the violency, is going to be present. So again, stopping action. But then the second punch was such where maybe if the third punch happens, and even if a smaller or lighter punch happens, the first two kind of knocked out the uptrend to the point where the third one is just kind of takes you more down. And that's where you have that ease of movement. So you go to, you fall down as a boxer on that third punch, and it wasn't even that great. So that tells you that you don't have any legs behind you, right? So then what do? You kind of trying to avoid being in a trouble by not exerting a lot of energy. That's what this rally about. And then you're gradually just going to collapse and capitulate at some point, and you're going to lose that fight. So that's how this fight, in McDermott was lost by the buyers. But it's very specific to the leadership characteristics, the way how the distribution unwinded. It's also very specific to the overall market at that time. And that was the challenge as well. It was just this mixture between the market behind on the background is already going down, and I'm showing you a leadership stock. So a little bit tricky from that perspective. Is a distribution during the buying climax range, or is it rotational sell and buying? Well, a good question to ask at that point, right? So, is this a rotation between institutions, or is this a distribution? I would say that it's probably both. Why? Well, because we see in how the value investor distributed the stock, but it doesn't mean that other institutions distributed that stock as well, right? So where did they distribute the stock? Right here on the way down. So this is the rest of the institutions. So therefore, who picked up this size? Some weak hands. And weak hands could be both retail and institutional hands. And obviously with this volume signature, institutional hands are picking up. So from that perspective, there is a rotation that we see from value selling to short-term institutional, short-term value institutional buying, and that is weak hands. So rotation has happened. There was an exchange of shares from strong hands to weak hands, from strong institutional hands to weak institutional hands, and then those weak hands are capitulating somewhere to the downside. All right. All right, guys. Maybe we need to stop here and just go somewhere else. All right. Okay, Dmitry, thank you for your comment. And let's bring up this point maybe in another discussion as well. All right, great. Homework, the next buyer's game. This one is pretty easy. So I'd be surprised if we wouldn't have more than 80% success rate. And by the way, I still would like you to keep the record for each of the buyer's games that you have done, right? So I want you in the percentages, or you could just say out of 10, 5 I guessed correctly, 5 I didn't guess correctly. So I want you to keep that count on, and at the end of the semester I want those numbers, so you'll email me those numbers. All right, so this is the homework. Good luck with those, guys. And again, I think that this one is going to be extremely easy. Let's look at the anatomy of the trade. That was a very interesting, not just couple of days, 3-4 days. I thought this comment from Corey was really good. We were discussing you know, where SunPower could potentially go. We were thinking about some kind of reaction after the rally, or the rally takes us out. The rally did not materialize, so Corey was saying that we're expecting some kind of potential phase C if this is a backing up action, right? So if this is the range. Um, so I think that at the point, this is exactly how we would be thinking, because we said that we've experienced a major sign of strength, and we know that from here we're going to go into a backing up action. That is going to be a major backing up action as well. So we know that the duration of the range is going to increase. It's not going to be just this area and then we're going out. We just bought in here with an idea, as I think that the class was communicating at that time, that we're going to go through the consolidation and then we're just going to be in this position. So that was the logic at that time. And this is actually not the latest price. So let me update this. Here you go. Look at that. And guys, you have to remind me, where did we have the stop loss? Did we have the stop loss just below, slightly below this area right here, somewhere below 11, or was it below 10? Did we use two support levels away? I just don't remember. Remind me really quickly. Between 9 and 11, was that, well, 10? Well, to me, that really doesn't matter that much. So, I mean, between 9 and 11, where? If it's between 9 and 11, we are either hit today or we're not hit. So I'm not sure. I think, okay. Eric is saying, I think that we were 2 support levels away because we were not moving. Okay, well, let's just say that it's just slightly below 10. And that we just enter in the first tranche, we were not in the position, and therefore, you know, this is where the stop loss is. Okay, so the stop loss is not hit. That doesn't really mean anything for this position. I mean, like at this point, what are you gonna do? Are you gonna still stay in the position, or are you gonna get out of this position, scale out? So let's go through the poll first, and let's see what you guys are thinking about this. What should we do at this point? Should we close the position? Should we keep it? And what would be the logic behind keeping this position? Okay, well, interesting. Okay, one more vote. Okay, the more we are voting, the more it is to the closing of the position. Okay, let's do this. Let's close the poll. All right. And please note that the price is actually at 1040 as of today. So the slide that I have is a little bit outdated. Okay, so we are somewhere here. This is the range for today, also a down day. All right, so what are we saying? Okay, 40%, keep it, 50% close it, 10% keep it and sell some. So I would say that probably this is 50-50 in both cases here to keep. Still the majority is saying to close it. Um, okay, well, yeah, absolutely. I mean, like we definitely just can close it, but what's the analysis here? Because why are we doing this exercise? This exercise is not uh, constructed to be in the necessarily winning position all the time. This exercise is constructed to be in different positions, whether they are winning or losing positions. And the key here is to kind of soundly understand the logic of how we're handling and managing the position. That's, what this class is about, tactics, execution, and all that stuff. So what is it that we're doing? So the class is saying, let's close it. Okay, well, I think it makes sense to think about a closure here. Let me bring some arguments towards this. Let's say that if we've been in this position for some time, there is a lot of sense to take some profit as we go into a major sign of strength. So probably we would be thinking that this major sign of strength is going to have some kind of bind climax characteristics, maybe some testing. We would be thinking also that a big backing up action, major backing up action, could translate into the trading range. And then we have our stop loss, kind of like a catastrophic stop loss. Let's just say that it's just below 10, so we're very close to that. We're hitting here, and we actually overcame the support trend line that we're seeing on this chart. So we just committed below. The relative strength is below the moving average. We had a lower high here. The momentum had such a divergence from the price. So we needed to see some kind of expectations of the price going down at this point. So the key for us would be probably to exit on the way up, like on this bar right here, on the first test, the failure of the test, or the failure of the upthrust right here, if we are exiting and if we are profit taking. So exits, profit taking. And then if we are long-term investors, the biggest question that we have, is it a distribution? Is this a, and I don't mean late distribution, is this a terminal distribution where everything what have been accumulated throughout the years in the stock have participated in the move to the upside, and now we're done? So I want to ask you this question, guys. With everything what we've seen on this chart in the last 3 months or so, maybe 2 months, and especially with this, last 5 days move to the downside, are we in the distributional pattern that is the terminal distribution, or is this just a temporary distribution? What do you guys think? Okay, and I just kind of feel like I have this, I'm leading you to this answer, so everybody is temporary to the distribution. Okay, as a long-term investor, we've accumulated the shares uh, somewhere here on, still as the price was going, it was establishing itself on the way up, probably throughout this period of vertical absorption, which reminds me a lot of Feather. So everything else is the momentum to the upside, some supply that comes in. So I would say for the long-term investor, you probably thinking that anything below $8 where I bought is probably going to be really bad. Everything else is just going to be volatility, speculation, and so on and so forth. I don't necessarily see a lot of supply coming in. So it might not be a distributional supply. We definitely had some value selling on both of the moves to the upside. We see that. We recognize that supply has increased, and this is the supply that stopped the price from moving further up. Maybe because the stock has made a freaking ×3 in less than a year. So, and a lot of the value investors, where they have such a great return, they're gonna profit take, and that's what happens here. And some of them are going to be totally satisfied with this position for the rest of the year. And they would say, maybe I will come in, somewhere later. I think the key here is just to recognize this buying climax and then to have a plan as to what you are doing at this spot. Because your options are so different. If you're a swing trader, then you're definitely out. That's your exit. If you are a long-term investor, then you have options here. You could do nothing to your position. You could hedge, and you could do the hedge in different ways. And then you could just take some profits. There is no sense to add to the position at this point, but there is a lot of sense to do other things. I think that the key here is to do those other two things: either hedge or take some profits. And you could do actually both. You could take some profits. Let's say you could sell, let's say, like 1/3 to 1/2 of the position, and then for the rest, 1/2 of the position you can hedge. And the way how you hedge, you could, let's say, sell premium, sell calls, you could buy puts, whatever the strategy you could have. You could also try figure out and finding maybe a stronger candidate at this point in the same group, and then do this spread trade. But this is a little bit more complicated, so spread trade. Buy stronger asset, buy stronger solar stock, and then sell SunPower. That would be your pair trading or spread trading. Let's not think about this. I think that the easiest concepts are going to be just, take the profit or just hedge. I think that for the long-term investor, hedging is much better alternative. Why? Because you still, have the same type of size if you hedge, and you want to make sure that on the buying climax you have that hedge strategy, which makes your position neutral, and if the stock goes down, then you're not losing a lot of equity. This is something that we will be talking about in December. This is going to be like the culmination of all of this knowledge coming together. I will literally show you in the price cycle different positions of where the stock could be and what those positions would mean relative to the signal that we're receiving. And then we'll talk about specific tactics that will be defined for the specific position. So like position number 1, position number 2, position number 3, and so on and so forth. So each position will be associated with the specific identification, and behind this is going to be specific rules and scans to find those spots. And then the next layer is going to be tactics. What kind of strategies we're going to use at the specific spot in the price cycle. So I'm just talking about specific spot here. This is the spot that tells us that the long-term uptrend is confirmed by major sign of strength, and it needs to be confirmed by the backing up action still, and that we are in the short-term overbought condition at this point, at this buying climax and in this trading range. So therefore, we're going to expect some kind of change of character. A change of character comes after the buying climax. Is this a change of character relative to the previous reactions? Probably not, right? So it's just a change of character to the last move to the upside. But this looks more like a change of character. So we're probably going to have like a meaningful change of character. Maybe it's going to stop here. Maybe it's going to go even slightly lower to about this area right here. I'm kind of hoping that we're going to struggle here so that there would be some knowledge coming out of that struggle. But let's say that if we have that change of character, the price touches the moving average and then it just rebounds up and then consolidates. And we could stay in that consolidation, in that backing up action for quite some time. So that's what we're trying to do here. We're trying on the real example, try to go through all of those price cycle positions where we are seeing the emergence of the trend, short-term overbought condition, so therefore a hedge position should be initiated here or some profit taken. By the way, my initial position was initiated somewhere here on this reversal right here, some add-ons on the way up, and then I closed out over 90% of my position on this bar right here. So this was the predominant trade. The reasons, exactly this, exactly what we've been discussing, the buying climax. So now I'm approaching this exercise as, well, together with the class, we have this position, we went it on this bar, and here's our stop loss. So this is how we're managing it, and then we'll find a way how to analyze it. All right, guys, I think that's it for this segment. Let me see a comment. The small reaction in late June of 2019. Has less volume than the upthrust in mid-April of 2018. The next high reaction in June. I'm sorry, this one right here? Oh, you mean this? Okay, so, all right, I got you. Yeah. Okay, so the question, could that give us the confidence it would not be distribution, especially when that resistance lines was broken to the upside? Okay, so something that is being taken from the WTC exercise that we usually go there. Identification of the supply on the way out, right? And how we go through this level. So this is a very important task because you basically trying to gauge whether you're going to have some kind of continuation of the move after supply emerges. And there are quite a few spots like this that we see in the uptrend where the price breaks to the upside, supply occurs, and then what do we expect from this and how would we interpret this? So there are quite a few instances here. I'm sure that this is not all. There are kind of like smaller instances as well. Let's see, like this one right here. And just some smaller ones, but I don't think that we need to go through all of them. But we're seeing the supply coming in and the shares are being sold into the strength. And then what happens after that supply spike? Reaction. What happens after the 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 supply spark? spike reaction. What happens after the supply spike, which is less than any other supply spikes that we had so far? Reaction, but horizontal reaction without the continuation to the downside. If you could see that everywhere we have that continuation to the downside, where we're going down, we're going down, we're going down, we're going down, we're going down. So what happens here is that the sellers still provide the force, the effort that stops the price from going further up. And once they sold into this strength, they're not selling anymore. Maybe they're selling, you know, like here on the continuation, and then the price collapses. This is the first time in 2019 that we see that change of behavior, not the change of character, but the change of behavior. The way how supply comes in is the same way, but it's less of the supply. That's number one. So the effort is less to resist the uptrend. That's great because that tells us that supply is exhausted. There is more chance for the price to go through this level now at $6. And then the price structure itself of the reaction is horizontal. It's not vertically constructed. And then we definitely don't have any supply there. So that's a change that happens. Then the next time supply comes in as a spike, supply actually increases, and it's at the higher level. It's at $8 now. So we are basically testing, you know, all of this attempts to go up. Would we break through that level? Would we sustain that uptrend? Would we be able to absorb this supply at the higher level now? And indeed, we do. And instead of the vertical reaction, again, we have a horizontal one. So we have done the same action at $8 as we did at $6. Supply came, the market observed the supply, we reacted more horizontally, and then the next supply comes. And also a horizontal structure was just a sign of strength in the middle. And we're still observing that supply that came right after the test. After the supply comes, you know, we have a successful test. And then the last one, supply comes at a huge quantity. This is the largest supply. So here we also will be thinking relative to the magnitude of this supply. If we're going to have a much larger structure, would the structure hold on? Would we have this horizontal structure rather than just reaction to the downside? And that would be our judgment on the very long-term trend. Okay, yes, good observation there. All right, guys, let's retire from this segment. Let's look at the time for 11. Okay, great. All right, let's jump into the Q&As from Simon. We've been looking at the point of entry and point of exit using the key Wyckoff events. Can we still use Wyckoff to also assist with swing trading, such as when within a trading range? Would this be simply identifying the climactic actions, for example? And we should have a chart here. Okay, so let's go to the chart. Doesn't really matter what chart we're taking. So let's say we have this SunPower, and we're looking at the consolidation. So the question here is, about trading range and how we would trade it. Would we be trading it as you know, isolation trades? Absolutely. So we're thinking about here what? We're thinking about mean reversion, which is basically you have the mean and the price deviates around this mean. And we're in the trading range, so we are in the horizontal structure. with this, whenever you recognize this environment, you have to go to oscillators to define the extremes. And you just basically buying and selling extremes. Now, we have to put our Wyckoff layer on this as well. And therefore, we'll be thinking about the structure. And specifically what structure, phase analysis is going to be extremely useful. We would want to understand that once we have experienced a selling climax, perhaps here, we could expect some kind of move to the upside, which does not happen right away, by the way. We have a whole structure, a trading range that belongs to a stop in action. That's how the price has stopped here, diminishing supply characteristic, and then a suggestion for the rally. So what we would be looking for is some kind of short-term oversold condition in order for us to create short-term swing trade with the target at previous resistance. In this case, the resistance was not well defined, maybe here, and then obviously on the highs of the preliminary support. So here we are kind of expecting the price to go into this area. You are trading this. Then you define automatic rally high, and the reversal out of that could be a trade out of the extreme where you're expecting the price to go to this secondary test. That would conclude phase A. Then you could buy it with the expectation that there's going to be a rally into phase B. In this case, an upthrust action, which was so nice. So you know that you are here in the extreme overbought condition. So at the first signs of capitulation, and you could even just think that this was a capitulation right here. So a trade could be established here. But here for sure, and then on the open of this bar, and then on the continuation here, you're expecting that the price is going to come down to the level of the support. And then you're just, again, trading it back and forth until you recognize the elements of phase C. And then when you trade phase C, then you just stay in this position. And that's the key, just to define that. By the way, look how dramatic this change of character looks now. It's probably even more dramatic than what we have had here. And this is kind of like the spot that reminds me a little bit of the structural way of how the price traveled. A lot of aggression, volume signature, and then some kind of smaller range, and then a very quick move to the downside. So what are we expecting here? We would be using the same analog, and we would be thinking if we're going to have this type of the consolidation where the rallies are mediocre, we might actually have a continuation. So the long-term investor that was accumulating the shares here will be capitulating somewhere here. The long-term investor would not be capitulating on the first change of character because it means still nothing to the idea of the long-term trend. Okay, great. Next question. Do we have an equivalent diagram of the above for the distribution, redistribution that details the points of entry and points of exit? I will bring this up in the news cycle of the WTC, Simon, and once I have that slide, I will present it here in the practicum, so you guys will have this. And then the comment, the bias game is absolutely fantastic, such a great exercise to put the theory into practice. I've been looking at the bias game on Twitter and then the solution that you post later on. Yes, I want to point your attention, guys, do not look at Twitter solution unless you're done with your homework, because it's the same week that we have the same game. You have 1 day head start on the whole Twitter group, and that's advantages of having a class on Tuesday. So whenever you send me your answer, then look at Twitter, and usually the answer comes on Friday. On the Twitter feed, I find it a little difficult when scrolling through to match up the bias gain with the particular solution slide. Is there a unique identifier that you use to match them up for ease searching on the Twitter feed? We will think about this. So Simon, thank you for this feedback because I actually agree with you. It is a little bit hard to find when you look at the solution, to find the original slide and to find like what did we start with. So I'll think about that. This is very interesting. Eric is asking, do we become mean reversion traders within the trading range until phase C? Well, not necessarily. And again, in December, it kind of will all make sense. I will put different layers on the price cycle and we'll look at this from different angles and it will all make sense. But the mean reversion trade will always be on. Here's your mean reversion trade that happens in the trading range. And then this is your mean reversion trade that happens in the uptrend. What am I doing? Well, it's the same trade. It identifies short-term overbought, oversold conditions, but it's just in a different environment. So throughout the whole price cycle, there are traders that are just doing that. Our goal, and again in December, I will show you guys, what to do and how to do this. And you kind of could see how that trade unfolded for me, right? So accumulating somewhere around 6 and then getting out after the first signs of the, a buying climax here. And that's just a tactic that I'm using in the whole price cycle. But we'll talk about how the mean reversion trades at the specific spots are going to be the trades that we want to do as well. So we'll talk about that. All right.